Okay, in this video, I just want to go through some key things related to net foreign debt and net foreign liabilities. Just some things we may have gone over a little bit too quickly in class that I just wanted to recap before next week. So just a bit of a recap. Sorry about the bad print screen. Does a higher current account deficit always lead to higher net foreign debt? No, it doesn't, because we can sell off assets instead of borrowing money. What might happen to a country's level of current account debits in the future if we have high levels of net foreign debt? Again, that will mean the interest repayments are higher in the net primary income account, so more money will flow out. Net international investment position is basically the same as net foreign liabilities. So that's your net foreign debt, the amount we owe the rest of the world minus what they owe us, plus your net foreign equity, which is the total stake of foreign investment in Australia, property, shares, businesses, minus our stake overseas of property, shares, and businesses. How might an increase in the unemployment rate help to reduce Australia's CAD? Well, the more unemployment there is, the less money Australians have. The less money Australians have, the less spending that they do, and that leads to less importing because a high proportion of our spending goes on importing. Other things you could talk about is that when there's high unemployment, generally inflation's low. That leads to reductions in prices. It makes us more internationally competitive. It also helps to keep wages down because there's more supply than demand for labour, which also helps to keep wages down, keeps cost of production down, and makes us more competitive, which can lead links to increased credits. How would lower world interest rates help reduce our current account deficit? Well, basically, lower world interest rates would reduce the amount of debits in the net primary income section of the current account because we wouldn't have to pay as much interest for our debt. Where are profits received by Australian companies operating overseas recorded? They're recorded in the net primary income account, and they're an example of a credit. So, just in terms of trends in Australia's net international investment possession, net foreign liabilities to continue to grow, but they've been doing so at a slower rate in recent times, and that's because the current account deficit has fallen. So we're still spending more than we're earning, but it's growing at a slower rate because there's a smaller gap between the two. The main reasons for Australia's high level of net foreign liabilities is because we don't have enough national savings, both in the private and the public sector, and therefore we are forced to borrow from overseas. So countries with higher levels of debt generally experience large financial account surpluses because they run current account deficits. Countries with higher levels of net foreign debt are likely to see large outflows in their current account for interest, dividends, and profits. If Australia continues, actually we'll talk about that a bit later on. So just in terms of the relationship, we went through this in class, but a higher CAD means we have to borrow more. That will lead to a higher net foreign debt, or we sell off assets, which leads to more net foreign equity. An increase in net foreign liabilities is likely to lead to a higher CAD in the future because we are forced to pay dividends and profits back overseas from that borrowing or from that selling of assets. There'll be higher debits in the net primary income account because there's more interest and dividends. How can explain the impact on net foreign debt and net foreign equity of an increase in the current account deficit? So define what net foreign debt is, define what net foreign equity is, explain that when we run a current account deficit, that means that the payments to foreigners, or to the amount of spending exceeds the amount we receive. This leads to means we need to fund that through borrowing or through selling Australian assets. If the money is borrowed, net foreign debt goes up. If the current account is financed by selling assets, then net foreign equity will increase. Okay. Distinguish official debt from non-official debt, noting which of the two is higher, and identify and explain two factors that have led to the rise in official and non-official debt in recent times. I'll go a bit slower with this one because this is something we didn't do as much in class, but basically official debt is the government's borrowing from other nations. So it stems from when the government sells bonds to cover their excessive spending. So when they run budget deficits, they sell bonds because they need to fund their deficit, and that leads to an increase in government sector debt. Non-official debt is the debt of the private sector, which incorporates our banks. So a lot of the debt is our banks because they need to borrow to fund, to then lend to consumers and businesses. The debt of businesses and the debt of individuals. So non-official debt, banks, businesses, individuals. Non-official debt is higher because the private sector makes up most of our debt. Two factors that have led to higher debt levels. The two main ones at the moment is the government consistently running budget deficits. So the government needs to finance their borrowing, and that leads to higher official debt. And the main reasons leading to private sector debt is the lack of national savings. So particularly high property prices means that we have to borrow a lot to get a house. The banks don't have enough money to fund that, so that leads to them having to borrow from overseas. So to make that really clear, Private debt is due to a lack of national savings, and the private sector having to borrow to buy houses, and government sector debt is due to the government running consistent budget deficits. Explain the impact on net foreign debt of the two. We talked about this in class, so I might just skip this one. Gross versus net foreign debt. So gross debt is all the amount we owe to countries overseas, whereas net foreign debt is equal to the gross debt minus any lending by Australians. So it's the value of what Australia has borrowed minus what we have lent. Two main types of debt. Again, we didn't talk about this a lot in class, but your public sector debt is the same as government debt. So when you see the word public sector debt, that means the debt of the government. That's around 20% of our debt. It's growing because they consistently run budget deficits, but it is the smaller of the two. Whereas private sector debt or non-official borrowing is the borrowing of large companies and financial institutions like banks, and that makes up around 82% of our foreign debt, or a large proportion of that debt. Together, they basically make up around 60% of our GDP, or around $1,000 trillion. So reasons Australia's debt is so high. Again, we've run budget deficits since 2007, so you can link that to public sector debt, which is a proportion of foreign debt. Low national savings, so because of high property prices and a lack of national savings, that forces us to go into debt as well, because we have to borrow a lot to purchase houses. Other factors, we constantly run a current account deficit, so we're constantly spending more than we're earning. That leads to more debt. And we also prefer to borrow from overseas because Australia's interest rates are generally higher than countries overseas. So Australia has a tendency to borrow from overseas. Okay, so when you see the word national debt versus net foreign debt, national debt is the same as saying government debt. So it's a little bit confusing, this one, but national debt is the same as public sector debt, which is all the money owed by the federal government, whereas net foreign debt is all the money owed by all Australians, businesses, the government, etc., but minus what they owe us. So national debt is just all government debt, it's gross, but net foreign debt is all the debt of the government, private sector, and businesses minus what we lend. Okay. Why is net foreign debt riskier than net foreign equity? Net foreign debt is riskier because essentially we have to pay, if we issue debt, we have to pay them back regardless of our own financial hardship or how badly our businesses do. Whereas equity holders, if they invest in Australia and buy shares or buy part of a business, they're taking the risk that their investment will expose them to losses. So in essence, the more debt we take on, the bigger the risk because we have to pay that back regardless. So distinguish between the two and explain why controlling net foreign debt is more important. Net foreign debt, again, another definition, you should know that by now. Net foreign equity is the total amount of investment in Australia. Provide some examples. Minus what Australians have abroad. Net foreign debt's from borrowing, where net foreign equity is from selling assets. Net foreign debt is more important because it makes up the majority of our net foreign liabilities. It's also more of a risk because when Australian businesses are suffering, they're still required to pay back their debt, whereas foreign citizens take the risk when they invest in Australian businesses. So net foreign debt is the riskier because we have to pay it back regardless. So last thing in this video, costs and benefits associated with excessive debt. So in terms of public sector debt, so this is government debt, and here we're talking about private sector debt. Problems with public sector debt is that the government may have to pay back their money and may have to cut their spending. So they may have to cut spending on welfare and education and infrastructure because of the amount of debt they're in. It can also mean that there's austerity measures placed on citizens. What that means is that the overseas sector may say to our government that they will lend us money, but only on the proviso that they reduce their expenditure. So they cut welfare or they raise taxes, and that can have a negative implication for society. So it can lead to austerity measures is one problem with public sector debt. Another problem is it can hurt our credit rating. So we have a AAA credit rating. If we were to lose that AAA credit rating, then that might increase the cost of borrowing. So the interest rates on our loans would increase, and then we may not have the potential to grow our productive capacity and boost our economy because we're seen as a more risky investment. It can also lead to higher interest rates on loans because they don't want to lend to us because it's a more risky investment. So the benefits of net foreign debt, increasing Australia's net foreign debt is not a bad thing. We use debt to invest in a lot of productive areas. So we use debt for infrastructure, we use debt for capital, we use debt to try and build roads and machinery, which all help to increase our productivity and keep prices down. So there are benefits of net foreign debt, and they stem from, if we use that money productively, it should help to boost productive capacity, it should help to boost our productivity and increase our international competitiveness. So just a bit of a summary. In terms of the benefits, it can help stimulate economic growth and make up for a lack of national savings, so we can use that money to then expand our productive capacity. We can also get access to cheaper credit. So the banks would be forced to charge higher interest rates if they couldn't lend from overseas, borrow from overseas, because they wouldn't have access to enough money. So by being able to access money from overseas, that helps to keep interest rates low. In terms of some negatives, as I said, the high interest repayments and high profits and dividends flowing overseas if it's related to foreign investment. It can hurt our credit rating. And if we're selling off a lot of companies, it can also lead to a lack of identity. If we're selling off a lot of Vegemite and Arnott's, all the profits are flowing overseas, and that's not a good thing for our economy. So explain why an increase in net foreign debt may be associated with an increase in long-term living standards. Increasing Australia's net foreign debt is not a bad thing as long as we use it for productive purposes. So if the money is spent on infrastructure, machinery, technology, that will boost our productive capacity, then that will allow for long-term non-inflationary growth and boost our purchasing power, keep prices down, and also boost our competitiveness. So it's all about if we spend the money productively on infrastructure, then it's a good thing. In terms of why there are problems, it can mean that people overseas lose confidence in our ability to repay our debt, so it can lead to a reduction in our credit rating. It can lead to higher interest rates on foreign loans because, again, we're more risky people to lend to, so they're less willing to lend to us. That can lead to a reduction in foreign capital and can also lead to businesses being unwilling to lend to money to Australia altogether. A higher net foreign debt can also depreciate the dollar, which we'll talk about another time. Okay, so is it possible for net debt to exceed net foreign liabilities? Yes, it is, and that's because Australians have a bigger share in overseas assets and property than they do in Australia, so net foreign equity is negative, and therefore net foreign debt exceeds net foreign liabilities. Why is net foreign debt riskier? Because foreign lenders will demand repayment regardless of financial hardship. Equity holders, overseas investors are the one taking the risk that if they invest in a company and they go bankrupt, then they may lose their money. One important cost and one benefit of net foreign debt. One cost of net foreign debt is that going to hurt our credit rating. Other countries may be more reluctant to lend to Australia, and they may also charge higher interest rates, which might jeopardise our ability to grow. One benefit is that it gives access to foreign funds, which we can use for productive investment into roads and bridges and hospitals and infrastructure, which we can use to maximise our living standards.